Welcome everybody again to our 27th episode for Bay Area Housing Market Town Hall webinar. Want to make sure and remind everybody to subscribe to our YouTube channel. All of these housing market webinars and also, some of our speakers have shared really good information there on our YouTube channels. We have over 200 videos right now, so please do subscribe. And also, if you find it a little bit too overwhelming, go to our website, haylengroup.com/HG-TV. We have different playlists, so you can kind of just look through town hall webinars, look through housing market updates, or we even have workshops for commercial real estate, so you can go through all of them, and hopefully that can help you as well. I want to introduce you to Diana. She's the CEO and president for Chan CPA, and she has over 25 years of experiences in different large auditing companies. And to be honest with you, she's my secret weapon as well. She's our CPA, and so every time I talk to her, she always shares so much information. So now I'm sharing her with everybody. Hopefully you guys will enjoy listening to her as much as I do and help you to find out what are the best tax saving strategies. So welcome, Diana.
Thank you very much. Hello, everyone. I wanted to have an opportunity to tell you a little bit about Chan CPA before I get started. Chan CPA and Company, Inc. is what we call a passion feeling organization for tax savings for clients that are small to medium-sized businesses and individuals. We really care and nurture every single client. We call it our white glove effect, because we want to make sure that you take care of what you need and your technical expertise, and we have the opportunity to take care of you and making sure that we remind you, nurture you, educate you, walk hand in hand with you so that you understand what the tax laws are, what your opportunities are, and what specifically case by case are your needs that we can help you to have tax savings for. What I wanted to also let you know is if you would like any of our handouts that I'll be going through in our presentation today, please feel free to reach out to us at client services at chancpa.com. As well, if you would like to reach out to me directly, feel free to do so. My telephone number is on the board, as well as our fax number. Feel free to take a look at our website, www.chancpa.com, and you can also have an opportunity to see our team members. So what are we going to be talking about today? We are going to be talking about, and I added this for you, Helen, because I wanted to make sure that we had 2021 and 2022 tax strategies for entity selections. And the reason I did this is because it's still not too late. There are still things that you can do for 2021. Having said that, what we did for our clients was we went ahead and sent out our emails and conversation scheduled meetings so that we could decide what to do by December 31st, 2021. And that gives us better opportunity to do whatever tax saving plans we can do for 2021. But there still are things, guys, that you can do for 2021. And I wanted to go over some of those things. Now, I recognize as real estate professionals and also real estate investors, there are different choices that you have as to entities. Now, as real estate professionals, many of you are individual shareholder corporation, or you might be an LLC with 2 members or a partnership with 2 members. These are very, very important things. I saw in some of the questions that came through Helen's people that you asked, what can we do for 2021 now? And what can we do for 2022? Or what are the new tax laws for 2021 and 2022? There was one very special and unique tax law that came into play in 2021, and it was passed by the state of California. So for many of you who are California residents and also who file in the state of California, either as an LLC or single member LLC or an S corporation, there are things that we'll really need to talk about. Unfortunately, for those who are single member LLCs, AB 150, and I don't know if anyone has ever heard of AB 150. That's Assembly Bill, California Assembly Bill, AB 150. That's what this is. It could save federal taxes for individuals as shareholders of S corporations and for those who are partnership entities and LLC members who are 2 or more. What is this thing? What is everybody's? I know you've heard it. It got passed in July. The paperwork and the forms did not get passed through and set up until November of 2021. And we started doing fourth quarter tax projections for our clients for 2021 because there was an opportunity, a tax savings that could occur in 2021. But believe it or not, you still have the opportunity to do this tax savings for 2022 as well. If you are a shareholder of an S Corp, or if you are an LLC with 2 members, or a partnership with 2 members or more. So what this is, and I know all of you might have heard this acronym SALT, which is the state and local tax computation for federal that got limited to $10,000. The purpose of AB 150 was to help the small to medium-sized businesses. That's really what it was for. And it was to do a workaround to the limitation of the $10,000 itemized deduction that was a pass-through that you would have had to do for your individual tax return. The maximum you could have taken as a state tax deduction was $10,000 on your itemized deduction. This was a travesty. This is really sad to see. And that's why you've heard a lot of things going on where SALT is not good for California, because property taxes in the state of California are more likely than not in excess of $10,000. So you literally are limited on your itemized deductions to $10,000, and that could have just covered your property taxes alone, not including your state and local income tax amounts that you would have had to pay, which if you have, for instance, a spouse who is a Schedule C, or actually a Schedule C or a shareholder. A Schedule C, you would have earnings of more than $10, $20, $30, $40,000, and you would have had to pay state income tax on it. If your property tax amount is more than $10,000, and then you had to pay state taxes for another $6,000, $7,000, $8,000, you would not have received an itemized deduction for that. This becomes a big problem when you have more net income from that from an S corporation or an LLC pass through. You know, you could have $100,000 or $200,000 in net income that you would have to pay state income tax on. It comes through as a K1, but you don't even get the deduction for it because your property taxes are already in excess of $10,000. That's what this was to address. And this addressed it really well. Had someone in your group informed you, hey, there's an opportunity to tax advantage. You pay the tax due amount on your 2021 tax return for your S corporation, you would get to take a tax deduction. Has anybody ever heard about prepaying your property tax? There have been times when before 2017, we would say, you know what? This is a good time to prepay your property taxes because you can increase your taxes deduction for itemized deductions. This is a similar situation where you can prepay your state income tax. The entity would pay it. That's why it has to be an S Corp or an entity like your LLC entity or your partnership entity. The entity would pay it. You get a tax deduction for it, and thus you could save thousands of dollars. That's what we were able to do for our individuals and our shareholders for 2021, because we asked them to prepay their state income taxes for their entity. And the entity paid it, so it got the tax deduction for it. Believe it or not, and I'm so proud of this, and this is how we are unique and distinct from many CPA firms. We really care. We really want to tell you, hey, there's something out there that you can do. We were able to save close to $500 to $1 million in tax savings consolidated for our clients. So we're really proud of that. So that was one thing that I wanted to share with you as it related to what can be done for 2021. It still isn't too late, because if this was not something that your CPA or your enrolled agent or your tax preparer did not tell you about, you can still have the entity pay the taxes when the taxes are due. when it's due on March 15th of 2022. The difference is you will not be able to take the tax deduction in 2021, but you can take the tax deduction in 2022. So come April 15th, 2023, you will get to take that tax deduction still. So it's still not too late to say, I elect to take this tax deduction through my entity. It is an election. You don't have to do it. Now, that is very important to know. So that's why I wanted to click. It's still available. AB 150 is still available in 2021 and in 2022. Who is it available for?
Yes. Dinah, and Lou want to ask, what about C Corp?
So C Corps are different. AB 150 does not affect a C Corp because, as you can see, the reason it affects the LLCs with 2 members and with shareholders is because it's a pass-through to the individual return. In a regular C Corp, it's its own separate entity. So in a C Corp, it already takes the tax deduction, whether it's accrual or deduction. But remember, in C corporations, my concern has always been, as I discuss with my clients, C corporations, there's always that issue of double taxation. So I'm not a big fan of C Corps versus S corporations. S corporations have the same kind of limited, and you should absolutely talk to your attorneys about this, but the reason I like S corporations is because it's a pass-through, so you only get taxed once as a K1, and it usually has very similar limited liability issues as a C Corp that you should be talking to your attorney about. And there's no double taxation impact, because whatever earnings that are left in a C corporation, the only way that the shareholder can get that out in retained earnings is through a dividend. And that's where the double taxation comes in. That's a very good question. Thank you, Helen. So unfortunately, AB 150 applies as well as S corporation. And why is that important? Because in the AB 150 rule, the money that is paid to the state franchise tax board is paid by the entity. So it is an election, and it is something that needs to be paid by the entity, not by the individual. That's how you get the tax benefit from it, is because the entity pays it, you get a tax deduction for it. And so instead of making $200,000, you'll make $190,000 because you paid $10,000 for state income tax. And that's the K1 amount that goes to your individual tax return as far as taxable income. So that's why it's so important. Additionally, and so I did it in an, so I think very, very much like one of those roll up your sleeve kind of people and your green shade when I go through the description of things to you. So I did it in Excel, but I also have it in Word for those, and PDF in Word for those who would prefer to see it in Word. And I'll be talking to it in Excel, but I have handouts. And so that's why I'm asking. If ever you guys wanted any handouts, please reach out to Helen or reach out directly to us at client services at chancpa.com, and we are more than happy to send to you the handouts that I'm going through as I'm discussing these informations.
And we will be sending out the recorded version of this video to everybody and include a link that they can download these documents.
Thank you so much. So additional things. So I'm going to go through 2021 because I know everybody is anxious. Okay, what else can I do? What else can I do for 2021? It's still not too late because you probably haven't turned in your information to your tax preparers as of yet. What is important, and I'm hoping that this has happened to you already if you are Schedule C, is that your health insurance premium deductions are deductible. And that is going to be deductible as a Schedule C or a single member LLC. It will also be deductible if you are a partnership or an LLC with 2 members or more. And there is a very unique way, but still deductible in S corporation. There are some specific rev rules that we have to follow as we work through the S corporation piece. But again, that is something that we can certainly, that you can still take that deduction for it. If you haven't followed the rules in the S corporation W-2 inclusion for 2021, you can do it in 2022, but still available for you to do. In 2021 as well, you will need to look at this because as a Schedule C, as an LLC, or two-member partnership or more, and as an S corporation, you can go through your information, your check register, and determine what pieces of equipment and what pieces of equipment you might have bought that was related to your business. And depending on when you put it into business use, you could potentially get 100% deduction, bonus depreciation deduction, or you can depreciate it. And we always like to look at our clients and determine what's the best approach. Do we want to take the depreciation on a consistent basis? It could be 5 years, 10 years, or leasehold improvements, depending on what that might be. It could be all the way up to 30 years. Or do we want to take 100% deduction for that piece of equipment? Or do we want to just take a small percentage of it? It'll be really important to determine what that is. I'm sure all of you are familiar with also the Section 179 and bonus depreciation for SUV, which is 6,000 pounds or more. When you have a 6,000 pound or more vehicle, you have the opportunity up to $25,000 for federal to take $25,000, 100% purchase price of that vehicle, and then depreciate the rest. But there is the opportunity if it were, say, 80% of business and only 20% use for personal. What you could do is you can take up to 80% of the SUV, $80,000. So that would be what, minus $16,000. So that's about $64,000 of deduction that you would be able to take immediately if you could justify the utilization of that vehicle as it relates to bonus depreciation and Section 179. That is in a Schedule C and single member LLC. But let me tell you a little secret. In an S corporation, if you were to do the same thing, and the S corporation the S corporation bought the vehicle, and there are different ways you can do that, which we can help you with. The S corporation could own the vehicle 100%. That means that the S corporation owns the vehicle 100%. It pays for 100% of all the expenses of that vehicle. There's a very secret, well, it's not secret, there's a very special way that you need to make sure that these things are done to make sure that it's still valid. Because many times, even though the S corporation is 100% owner of the corporation's vehicle, there are times when you would have utilized the vehicle for personal use. It's called personal use of automobile. When you have personal use of automobile, we will base it upon lease value and number of miles driven in the vehicle for personal use. We include that percentage, which we determine to be included as utilization of that amount. It could be $2,000, it could be $5,000, depending, it could be $7,000, it depends on the kind of vehicle that it is, how many miles you went for personal use. And the fact is, it does get included in your W-2. So unfortunately for S corporations, this is not going to be possible for 2021, but it certainly could be possible for 2022, where the vehicle could be 100% used and owned by the corporation, purchase it, owned by the corporation, and then we have you start tracking what miles you drive for personal use of automobile. And we include that dollar amount. Once we interpret what that dollar amount would be, we'll include it into your W-2 so that when you receive your W-2 at the end of 12/31/2022, it has been computed correctly as a part of your W-2 wages. But what's beautiful about this is that you get 100% deduction for all of the expenses on the corporation-owned vehicle. Another thing that we like to look at in 2021, as well as it will relate to 2022, is that we like to allocate or separately have enforced items from attorneys and for CPAs or tax preparers. And the amount that is allocated towards the preparation of your Schedule C, your single member LLC, your S corporation taxes should be billed and paid for by the Schedule C, single member LLC, or the S corporation or partnership. And that way you get the tax deduction for it. So why is that so important? Because the tax deduction not only reduces your income taxes, it also reduces, in many cases, your self-employment taxes when it's on the Schedule C or when it's on the LLC single member. So instead of it reducing it by whatever your current tax rate might be, an average of 20 to 30 cents on a dollar, it could also increase it to 45.3 cents on a dollar because of the 15.3% Social Security tax that you pay. So that's almost 50 cents on a dollar. So it's really important for your tax preparers to specifically allocate and tell you what portion of your was allocated to business portion compared to your personal portion. And many times I recommend providing a separate invoice for that, because that is very clear and concise when you go into audits. Another thing that is very important that still can be done for S corporations, LLCs, and two-member partnerships is expense reports for reimbursable expenses. So what I mean by that is you can use 2021 data and you can fill out a 2022 expense report. And what I mean by that is go through all your personal expenses through your check register, because many times when you're so close to your business, you probably did pay expenses that were related to your business on your personal credit card or in your personal bank account. Please, please fill out that expense report and get reimbursed for that. Even if you can't take the deduction for those 2021 expenses in 2021, you can submit that expense report to your S corporation or to your partnership, get reimbursed for it, because the entity will pay the expense through their checking account, and then the tax deduction is still going to be reflected. So do please make sure to do all of that, because there are still things you can do. Even though you might not get the immediate tax deduction in 2021, which you will file the tax return by either April 15th, 2022 or March 15th, 2022, you still have a chance. And that's what I want to share with you. You still have that chance. It still hasn't gone away yet.
Well, Diana.
Yes, Helen.
I'm wondering if maybe I can ask some of the questions that's on the Q&A box right now that relate to what you were saying.
Please.
Yeah, one thing is you mentioned
I'll try.
that you can still do. Paul is asking, can you discuss best business structure for a real estate independent contractor, example C Corp? Also, can we deduct health or golf club membership as a business development expense? And best QuickBook program for whatever structure I have, example self-employment platform or QuickBooks Essentials. So I guess question is like health, you had answered that already, and what about the golf club memberships?
So here's the things that I will tell you. First of all, you asked for best entity selection. This is why I did it in this way. It is definitely on a case-by-case basis, but what I can share with you, because with my background, and I don't know if it was, I didn't write it all into my background, but as a tax manager at KPMG, I ran and I headed up the expat department. And when I ran and headed up the expatriate tax department, they are the most complicated of all individuals. I will tell you that, because they've got that foreign piece with the Section 911. So because of that, I can tell you 150%, they got audited a lot. So we had many, many audits for these individuals. And in addition to that, lots of things would be incurred, Schedule C incurred, so forth like that, so forth and so on like that. Schedule Cs and single member LLCs tend to get audited approximately 20% of the time as an entity. You are an entity, it does tend, and these are statistics that are prior to 2021. So and this is also statistics prior to any budget increases that may be coming. So I'm just sharing with you what the statistics are prior to that. If you were an S corporation, if you were a partner, so S corporation, less than 1% audit. LLCs and entities, partnerships, they were in the 6 to 10% category. And small business corporations, and I'm sorry to say this, but they were in the 10% category. That's the C corporation, small to medium, small to medium-sized C corporations, 10% category. So there's what kind of entities, not just about the dollar amount, but it's also about the angst, the anxiety, what type of individual, how aggressive, how conservative. So it really does depend on many different things like that. In general, my most favorite kind of entity, honestly, and that's just my personal preference, is an S corporation. But there are specific, distinct differences of requirements of what type of entity you choose, is how formal the entity is, and what kind of out-of-pocket expenses you're going to have to incur. And that's what is going to lead to the next question that Helen asked, is what kind of QuickBooks do I need to have? What do I need to do? Well, it has always been my recommendation, if you are a Schedule C or a single member LLC, in addition to an S Corp or a partnership, I have always recommended very important things: separate business checking account, separate credit card, because it's not about the preparation of the tax return that is of importance, but it's also about forward thinking, proactivity, and getting prepared for the audit as well. So it's so important that those things are very, very critical to you. Now, I did see in the Google questions one that said, but I'm just starting out and I don't want to expend too much on anything much. You know, there are some QuickBooks online, very simplistic self-employed things that you could do, because it's just a very simplistic one. If you are an S Corp, you have to have a formal general ledger. That's just the way it goes. If you are an LLC or a partnership with 2 members or more, I recommend a formal general ledger. And the reason for that is, and that could be in QuickBooks, because QuickBooks Desktop and QuickBooks Online, they have some pretty complicated accounting software that still works. There are definitely other ones that we could certainly look into for you. Even QuickBooks has Enterprise, but it's so nice because you can invite your accountant to review and view the QuickBooks if you need to have that done. And of course, you know, CCIM can prepare and help you with your accounting if you need. But it's very important from that perspective. There are some additional out-of-pocket costs, though, and I want to share that with you. There's a separate tax return for S Corp. There's a separate tax return that, you know, and so because it's a separate tax return, California is going to require a minimum of $800. It doesn't matter whether you make money, you have net income or not. They're going to require a minimum of $800 to you. A C Corp does it, and S Corp is required. LLCs of any type require an $800 minimum, and partnership entities, most partnership entities will require an $800 amount too. There's a few that don't, but most do.
So Diana, go back to the different entities for, so
yes.
Let's say real estate investors is very known that to own a property, they would put their properties in an LLC. However, then you'll see that real estate agents who are earning more active income, they would use S Corp. Is it, now I want to make sure that one of the questions here is that, is it possible for LLC to be taxed as S Corp?
Yes, yes. In fact, we've done that many times. For clients, and we made recommendations for them. You will need to file special forms to get your LLC to be treated as an S Corp. And before you make that decision, what we normally would like to do is have a conference with you, sit down with you, and run a tax projection of what that's going to look like. Because LLCs for real estate investors are different than LLCs converted to S Corp for real estate professionals. And the reason I say that is it has to do with how the capital gain transactions work. And and we definitely do recommend that investors, that would be for you and an attorney to sit out, because LLCs mean limited liability company. And many times real estate investors will want to be an LLC due to the fact that it specifically says limited liability company. It's only limited to what that asset is going to exist to be.
Right. Yeah, it is really important to determine these kind, not just to talk to your tax accountant, but also your estate attorney as well, because it is part of the asset protection for your property.
Exactly. Exactly.
And we have about 10 minutes left. I know we have a few more questions, quite a few questions I promise I'm going to ask you.
So I just want to get down to the last two, because this is very important. It has to do with retirement contributions, because this is something you can literally do on your 2021 tax return. So I just wanted to get to this, and I'm so sorry, but I just wanted to get to this, because on the retirement contribution, if you haven't set up for your schedule, if you are a Schedule C or an LLC single member, and you have not set up your uni 401k, unfortunately, and it needed to be set up by 12/31/2021, it is too late to do that. But what is not too late to do is you have until the filing of your tax return, which means if you made Schedule C income, net income, or LLC single member net income, you have an opportunity to contribute up to approximately 25% of your net income into a SEP retirement contribution. And that will be a tax deduction for you. Remember, I said up until the filing of your tax return. And what I mean by that is that it is up until the extended approved tax return filing do you have the opportunity to contribute your retirement fund and file your tax return. So that could be up until October 15th of 2022. So I just wanted to get that out there to make sure that people are thinking about that.
That's perfect, because Daniel was asking about if it's too late to set up a defined benefit plan for 2021. So that, yeah.
Yes, it's too late for that, but you should definitely look into it for 2022, and let's take advantage of whatever you can do for 2021. The other thing that is very important to make sure that your tax preparers are aware of, although there are some specific requirements on qualified business tax deductions, the idea is in a Schedule C and a net single member LLC and partnerships and S Corp, you all could potentially qualify for a qualified business deduction of 20%. This was effective 2007. This is with the 2017 tax laws. So you should have been doing it already. But if this is the first year that you earned net income, you might have the opportunity for that 20% deduction. And so your tax preparer should certainly be aware of that and give you that tax benefit also. So Ms. Helen, I'm going to allow you to take more, so I can answer a few more questions. And as I should show you here, this is my Excel version. As you can see, I've got X's all over the place for S Corporation, and most areas are the same for partnerships and two-member LLCs, and a more limited version in Schedule Cs. So you can sort of see what my favorite is, but it really is case-by-case basis. And, you know, as I said, we welcome the opportunity for a meet and greet, and let's talk to each and every one of you.
Yeah, I love the fact that you put it on the spreadsheet with this check marks. It makes it so much easier and transparent of which one is probably the best entity to set up. But again, everybody's situation is so different, so definitely need to talk to your tax accountant for it.
So I'm just going to show you the handouts, because I'm just going to show you all the handouts so that you can at least see. There's a lot more to it, but I'm happy to send them to everyone. And I did the handout both ways, so Excel and Word in addition to that. And the one additional thing which is important for you guys to see, and that is that I did it in Word for all the opportunities. My thing is a little slow, so I can't do it. But at any rate, I just wanted to share that with you, that they were coming that way.
Thank you.
So why don't we continue? If you have time for questions, I'm happy to go through them. And if not, no
yeah,
problem.
let me just go ahead and ask these questions. So there's Vadim, actually, he unfortunately had it left already, but he was asking that I've been lending money secured by real estate. Do I need to send Form 1098 by January 31st to the borrower for the interest paid to me during the past tax year?
So the answer is it doesn't ever hurt to do that, because you have a supporting documentation, and your tax preparer would really appreciate it as well.
Okay, great. And then I have a few more questions that came before the webinar started. Andrew wanted to ask, what are the other tax implications besides capital gains I should be aware of when selling, and how to claim partial exclusion of capital gain?
So this is really important. This is why for Schedule Cs, I am more hesitant to honestly claim home office.
This is no, this is for selling a home, selling like a homeowner who is selling their own home.
Okay, this is for sell. So there's when you're talking partial exclusion, then you're talking about the fact that some portion of it was rented out. And is that why you would only get a partial exclusion? You don't get the $250,000 or $500,000 exclusion. So let me explain.
I believe that's what he was asking is it was his primary home, and he was wondering if there's any way that can do a claim partial exclusion, especially for the fact that if he doesn't meet that 2 years timeline. Yeah, as a primary home. I see.
So there are specific rules in place with the IRS. If there was a spontaneous situation in which you had to move from one location to another, they're very, very tight on what those rules are. But, you know, given what the circumstances are, it's possible. It is absolutely possible. But it's also possible to take partial exclusions on the $250,000 and the $500,000 tax exclusion if you rented out your principal residence for 3 out of the 5 years, but you still claimed 2 out of the 5 years it was your principal residence. We still can get around it too. Yes. So there are lots of different opportunities.
Yeah, absolutely. And to that question, another client or another audience had asked is there a capital gain tax calculator out there that he can use because he's trying to help his parents to sell their home?
You know, because of the fact that I am not certain that there's a capital gains calculator that you can use, but I can give you a quick and dirty number. You know, 20% for Fed and 10% for state. And it's about 30 cents on a dollar. And that is on the higher side, at least with the current tax laws as they are. And that gives you an idea. Remember though, if you're trying to determine this, it's always good to get a real tax projection because you have to include the $500,000 tax-free exclusion. You've got to make sure that you're including all the improvements, all the selling expenses, and there's a lot of things you might not think about. And especially if it gets complicated, like you rented it for a part of the time. And so some things could be that you would actually only get a partial exclusion for.
Absolutely. And at the end of the day, definitely, again, talk to your tax accountant. That would be the best way to handle this.
Absolutely.
And Shauna asks, I just started my own LLC at the beginning of December 2021 doing real estate transaction coordination. I'd like to know what kind of taxes I should expect to pay and how to save as much as possible. Business has been so slow, I'm afraid I'll get taxed more than I've even made so far.
So did she start her own business as a Schedule C or an LLC?
Helen? LLC.
Okay, so unfortunately, as an LLC, you're going to have to pay the $800. And if you filed the LLC on LegalZoom or something like that, they may not remember to tell you to file the $800 amount. So I'm reminding you now. Make sure you pay your $800 because the FTD may not remind you, and then you'll have a penalty. Additionally, though, it's in because you might be able to have startup expenses that you can amortize over 60 months. So it's really important that you start the LLC piece now and make sure it sounds like it's a single member LLC. It will be reported in your tax return, your personal tax return, but definitely go through your check register and acquire all of those expenses because the deduction will help you.
Mm-hmm. Great. Last question is it too late to mitigate penalties if you didn't file sufficient estimated taxes during 2021?
Yes, you might be able to mitigate some. There's still time. January 18th, 2022 is the fourth quarter estimate that is due. And that's what we were busy doing. In fact, I think I said yes to Miss Helen before I remembered, oh my God, I've got January 18th to deal with. But anyway, we did it.
Yeah, you have 6 more days to avoid this penalty. So please go ahead and do it.
Yes, it's a mitigation of some of the penalty, but there are lots of different ways that we might have been able to, there are lots of different ways you might be able to go through exceptions, because there's 2210 penalty exceptions. And it'll be really important as to making sure that each one of those exceptions have been possibly entertained before you have to pay those penalties.
Well, now I think everybody understand why I have you to be my CPA and my secret weapon, because, you know, I just feel so much better after I talk to Diana every year at year end with the year end projections, and she will teach us what we need to do in order to save taxes. That AB 150, that was awesome. We definitely elected that. So thank you so much. But I really want to thank you for being here, you know, sharing so much information with us. I'm sure you have helped a lot of people here on this, in this audience, and also later maybe on YouTube, that help them save some taxes for 2022 and hopefully make it for 2021. And hopefully we can invite you back next year and then teach us more.
Of course. My pleasure.
Well, everyone else, thank you again for being here. And just be sure to subscribe to our YouTube channel and come back. It's every second Wednesday from 4 p.m. to 5:15 p.m. We have an hour and 15 minutes to get your questions answered. So thank you so much for being here, and I'll see you soon. Bye.